All right, if you've been watching the markets lately, you've probably felt the anxiety. We've seen some absolutely dramatic, almost violent corrections in Korean and Japanese memory stocks recently. There's this huge narrative out there right now that the sky is falling on the semiconductor memory sector, and it's being driven by a cocktail of fears about future demand and pricing. But as we often find when we really dig into the actual data, the emotional reaction of the market doesn't always align with underlying reality. So welcome to this explainer. Today we're going to unpack this narrative, investigate the clues hidden in the numbers, and separate the market fiction from the institutional facts. Let's get into it.
Are memory earnings actually crashing? This is the exact question panicked investors are frantically asking right now. The sentiment out there turns so sour so quickly that you'd honestly think the bottom just completely fell out of the global memory market. It's almost like a financial mystery unfolding in real time for us. We've got widespread stock sell-offs, but we really need to step back and ask ourselves, is this panic actually justified by the fundamentals, or is the market just jumping at shadows?
Okay, let's dive into this by putting the dominant market fears right up against what top analysts are actually seeing. So the market is terrified of weaker than expected Q2 average selling prices, or ASPs. There's all this anxiety that earnings will miss the mark, that rigid long-term agreements will cap the upside, and so on. But counter to all of that noise, we have a very confident, data-backed narrative from Bank of America. Looking at the exact same market, they project earnings will actually meet or even exceed consensus. It is a massive disconnect.
Section 1. Bank of America answers the fear.
Pivoting completely away from the market emotion and focusing squarely on hard institutional data, Bank of America's bottom line is captured perfectly right here. Too early to expect an earnings contraction. They are firmly stating that all this fear is premature. In fact, their analysis projects that memory chip makers' Q2 operating profits are poised to easily hit or even completely beat market expectations. This isn't just a mild defense, right? It's a direct contradiction of the doom and gloom narrative that sparked the sell-off in the first place.
Moving on to Section 2, the conventional memory surge. So, what exactly is driving Bank of America's confidence? Well, while everyone was busy stressing over the rollout of new tech, conventional memory quietly became the unsung hero of this whole narrative. It's acting as a primary growth driver, totally defying the panic. Just think about the real-world results we're already seeing from major players like Micron and Nanya Tech. In Q2, conventional memory average selling prices didn't just hold steady, they jumped by over 50 to 60% quarter-on-quarter. That is explosive growth in the exact area where investors were fearing weakness. It just proves that sometimes the biggest clues are hiding right in plain sight.
And hey, if that wasn't enough to quell the fears, check out this export data, plus 193%. This represents the year-on-year South Korean semiconductor export spike for just the first 10 days of July. The demand isn't drying up at all. It is surging at an incredible triple-digit pace right now.
Let's trace how this built up chronologically, because context is literally everything when you're trying to solve a market mystery. Yes, okay, in April there was a brief dip in DRAM spot prices, and that tiny dip is likely what seeded a lot of the initial anxiety. But look at what happened immediately after that. We saw immense strength in South Korean semiconductor exports for 3 consecutive months, April, May, and June. And by June, those DRAM spot prices had already resumed their rally. The underlying fundamentals never actually stopped accelerating. The market just got hyper-focused on a momentary blip.
Section 3. The upward pricing outlook.
Now that we've firmly established the reality of Q2, let's look ahead to the horizon. Bank of America remains highly optimistic about Q3 DRAM ASP growth, and it really boils down to 3 distinct catalysts that crack this case wide open. First, more than 50% of conventional DRAM sales are actually not bound by long-term agreements right now. Second, we're seeing increasing shipments of next-generation high-bandwidth memory, HBM4, beginning to replace the older HBM3E, which effectively lifts the blended average selling price across the board. And third, newly negotiated quarterly contract prices are already up more than 20% quarter-on-quarter.
So the absolutely crucial point here is understanding the role of LTAs, or long-term agreements. Typically, these are very rigid pricing contracts. In a falling market, yeah, they protect the seller. But in a rising market, they actually cap how much money a chipmaker can make, which was one of those major investor fears we talked about earlier. But here's the reality check. Over half of all conventional DRAM sales are currently not bound by these LTAs. This lack of rigidity is actually a massive advantage right now, leaving an incredibly high upside for chipmakers to capitalize on the soaring price increases we just saw.
This lack of rigidity brilliantly illustrates the resulting global total DRAM ASP forecasts for the rest of the year.
So in quarter 2, we have that massive 53% quarter-on-quarter growth. Moving into quarter 3, BOFA still projects a very strong 21% growth on top of that previous already massive jump. And even as things naturally start to stabilize in quarter 4, we're still looking at an additional 7% growth. The data clearly shows hard, upward trending momentum. When you piece these clues together, it paints a picture of sustained growth, definitely not a market on the verge of a crash.
But wait, to maintain our analytical rigor here, we absolutely have to address a potential discrepancy. You might be wondering, what about Korea's lower quarter 2 ASP increase? It's true. While global trends were hitting that 53% mark, Korea saw an increase in the low to mid 40% range. If you're a skeptic trying to poke holes in this analysis, you'd probably point to this as a crack in the armor.
Well, let's look at why that variance actually happened. Korea's lag was purely a temporary quarter 2 specific variance. It occurred precisely because they had an exceptionally high baseline in quarter 1, combined with stable high-bandwidth memory prices during quarter 2. It wasn't weakness at all. They were just jumping from a much higher starting point. Looking at BofA's quarter 3 expectation, Korea's ASP trends are fully expected to align closely with the global trends going forward. This completely supports the narrative of strong, ongoing earnings momentum straight into the second half of the year.
Which brings us to our final thought for today. We've investigated the explosive conventional memory surge, the phenomenal export data, and the exceptionally strong pricing outlook for the rest of the year. The institutional analysis clearly contradicts the doom and gloom narrative. So I'll leave you with this. If the actual data points decisively up, how much is market panic costing you? It's a vital reminder that in the face of dramatic market corrections, structured, data-driven analysis is always your best tool to find the truth hidden beneath the emotion. Thank you so much for joining me for this explainer, and I hope this helps you navigate through all the noise.